This is the story of how a boring auto parts company transformed into a $9 billion criminal enterprise right under Wall Street's nose. For years, First Brands Group seemed like a massive success that owned household names like Trico, Fram, and Raybestos, which millions of drivers use every day. But behind the factory doors, there were no record profits. Instead, there was a shadow banking scheme so complex and massive that when it finally collapsed in late 2025, it left a $9 billion hole where the money used to be. The mastermind, Patrick James, didn't just break the rules. He shattered the entire system while leaving thousands of employees in limbo and some of the world's smartest lenders looking like complete amateurs. To understand how this happened, we must look at the man who built the machine. Patrick James was a Malaysian-born businessman who didn't fit the typical mold of a flamboyant fraudster. He operated quietly and bought up unglamorous manufacturing companies in the American Midwest. Starting with a company called Crown Group, James had a simple vision: to own the replacement parts market. He wasn't interested in flashy tech startups or volatile crypto markets because he wanted windshield wipers, fuel pumps, and spark plugs. It was the kind of business that banks loved because it felt safe, steady, and predictable. However, Patrick James had an appetite for growth that the replacement parts business simply couldn't support on its own. From 2018 to 2024, the expansion was relentless. James rebranded his company as First Brands Group and went on a shopping spree that shocked the industry. He bought Trico, the famous wiper blade maker, and then he snatched up Fram, the oil filter giant. Soon, he added Raybestos brakes and Carter fuel systems to the portfolio. These were legacy brands with decades of history, and suddenly, they all belonged to this one mysterious holding company. On the surface, it looked like a brilliant consolidation strategy. By owning all these brands, First Brands could negotiate better deals with retailers like AutoZone and Walmart. Revenue on paper skyrocketed to over $3 billion a year. But buying companies requires billions in cash, and First Brands didn't actually have that kind of money in the bank. Here's where the story turns dark. Traditional banks have strict rules about how much money they can lend, but there is another world called shadow banking. In this world, companies can borrow money quickly by using their unpaid invoices as collateral. It is called factoring or supply chain finance. The idea is simple. If Walmart owes you $1 million payable in 90 days, a shadow lender will give you $900,000 today, so you don't have to wait. It is a legitimate tool for many businesses. For Patrick James, however, it became a weapon. He realized that these private credit funds and non-bank lenders were so eager to deploy their cash that they weren't checking the details as closely as a traditional bank would. We are about to expose exactly how they faked the numbers. If you want to stay ahead of the next big financial collapse, make sure to hit subscribe and turn on notifications right now. Let's get back to the fraud. The fraud started with what investigators call fresh air invoices. These are bills for goods that were never sold, sent to customers who didn't exist, for products that were never manufactured. Patrick James and his inner circle, including his brother Edward, allegedly began manufacturing paper instead of parts. They generated thousands of fake invoices and sold them to shadow banks for immediate cash. Because First Brands controlled so many different subsidiaries, they could shuffle these fake papers between their own companies to make it look like real commerce was happening. The lenders saw official-looking documents from a company owning famous brands like Fram, and they wired the money without asking enough questions. It was free money as long as nobody checked the warehouse. Faking invoices wasn't enough to fill the massive hole in their finances, so they needed more. They started double pledging, which is the cardinal sin of finance. Imagine selling your car to one person, taking their cash, and then selling the exact same car to a second person the next day. First Brands allegedly took real invoices owed by legitimate customers and sold the rights to that money to multiple different lenders at the same time. Lender A thought they owned the invoice, while lender B thought they owned it too. Sometimes there was even a lender C. They were effectively borrowing $3 for every $1 of actual value. It was a Ponzi scheme built on windshield wipers, and the math was impossible to sustain. You might wonder how sophisticated financial firms fell for this. The answer lies in the murky world of private credit. Major players like Jefferies, Raystone, and Onset Financial poured billions into the First Brands ecosystem. These weren't naive grandmothers. These were Wall Street professionals. The structure of shadow banking often relies on speed over scrutiny. First Brands used a complex web of special-purpose vehicles and off-balance sheet entities to hide the true extent of their debt. When one lender started asking questions, Patrick James would simply pay them off with money borrowed from a new lender. It was a classic shell game, played with hundreds of millions of dollars at a time. While the company's balance sheet was rotting from the inside, the money was flowing out to fund a lavish lifestyle. Prosecutors allege that Patrick James siphoned off millions for personal use. We are talking about luxury real estate in the Hamptons, high-end cars, and a lifestyle that rivaled the biggest tech billionaires. The indictment revealed that while factory workers were making auto parts, the leadership was treating the company bank accounts like a personal piggy bank. This wasn't just about keeping a struggling business alive. It was about personal enrichment. They were buying homes in Malibu while the debt pile grew higher every single day. It is the classic story of corporate greed, but the scale here was staggering. By the summer of 2025, the music began to stop. Interest rates were high, making the debt harder to service, and the constant need for new cash became desperate. Lenders started noticing irregularities. Payments that were supposed to come from customers like AutoZone were missing or delayed. When lenders reached out to warning invoices, the stories didn't add up. Raystone, a major fintech lender, realized that hundreds of millions of dollars in receivables they thought they bought simply didn't exist. Panic set in quietly at first. Board meetings became tense and excuses were made. You can only hide a multi-billion-dollar deficit for so long before the cash simply runs out. On September 29, 2025, First Brands Group filed for Chapter 11 bankruptcy in Delaware. The filing sent shockwaves through the financial world, but the real jaw-dropper was the numbers. The company declared liabilities of over $9 billion. Against that mountain of debt, they had just $12 million in cash. Think about that ratio. For every dollar they had, they owed nearly $800. It was a complete insolvency. The sophisticated lenders, who thought they were secured by valuable assets, suddenly realized they were holding empty bags. The company that supplied parts for millions of American cars was effectively vaporware. As forensic accountants tore through the wreckage in late 2025, the scope of the disaster expanded. Raystone claimed that over $2 billion of their money had simply vanished. They couldn't find the invoices, the inventory, or the cash. It wasn't just bad management, it was a black hole. The investigation revealed that the company had been booking revenue that never happened. The assets listed on their books were phantom numbers. Creditors formed a committee, but they were fighting over scraps. The reality began to sink in that the money wasn't hidden in a secret account somewhere, but had been burned to keep the scheme going, or spent on private jets and mansions. Justice moved surprisingly fast. In late January 2026, federal prosecutors in New York unsealed an indictment that charged Patrick James and his brother Edward with conspiracy to commit wire fraud and bank fraud. The authorities didn't mince words and described the operation as a massive scheme to defraud lenders by lying about the company's financial health. Patrick James was arrested and later released on a $50 million bond secured by his properties. The indictment laid out the double pledging and the fake invoices in excruciating detail. It was the official confirmation that this wasn't a business failure, but a crime scene. While the bankers and lawyers fight in court, the real victims are the 26,000 employees of First Brands. These are the people working in factories, making wiper blades and brake pads, who had no idea their CEO was allegedly running a Ponzi scheme. Their pensions, their benefits, and their job security were all put at risk. The bankruptcy process puts the company up for sale, likely to be chopped up and sold for parts, which is ironic for a parts company. Suppliers who sent raw materials to First Brands are now unpaid creditors, creating a ripple effect that hurts small businesses across the supply chain. The greed of a few people at the top has destabilized the lives of thousands. The First Brands scandal is more than just one company's failure. It is a glaring warning light for the entire global economy. It exposed how fragile the private credit market really is. When companies can borrow billions outside of the regulated banking system, hidden leverage builds up in the dark. Experts are now calling this the next Enron of the private debt world. It showed that despite all the technology in finance, a few guys with a spreadsheet and some fake PDFs can still trick the world's biggest investment firms out of billions. Regulators are now scrambling to close these loopholes, but the damage is already done. As we move through 2026, the legal battles are just beginning. Patrick James faces decades in prison if convicted. The lenders are suing each other to claim whatever assets are left while fighting over inventory that might not even exist. The First Brands name will likely disappear, absorbed by competitors, or rebranded to wash away the stain of fraud. But for the financial industry, the scar will remain. Due diligence protocols are being rewritten overnight. The era of easy money in supply chain finance has hit a brick wall, and every other company using these tools is now under a microscope. The $9 billion collapse of First Brands serves as a brutal reminder that when a business grows too fast and borrows too much, the numbers rarely add up. Patrick James built an empire on paper, but paper castles always crumble in the rain. This scandal exposed the dangerous reality of shadow banking, where billions can vanish without a trace. If you found this examination of the dark side of finance valuable, make sure to subscribe so you don't miss our next investigation.